Welcome to another episode of Buck Talk Mailbag. I may be a financial advisor, but I'm not your financial advisor. This video is entertainment, not advice. Be sure to slap that subscribe button. If you got comments, put them down below. Let's get to today's question. Inherited IRA and first time home ownership question here in Georgia, in the US. Okay. So this person is the beneficiary of an inherited IRA, took ownership of it before the 10-year withdrawal rule, and had been taking RMDs for about a decade. So two things, a little background. When you inherit an IRA, you fall under one of two rules. So the new rule, if you're anyone other than a spouse, these rules are different for spouses, but assuming that it comes from a parent, the new rule, the one that applies if they die today, is you've got to take the money out over the next 10 years. You can basically choose when you want to do it. There are some really interesting questions about whether they'll try to add annual RMDs as well to that. It doesn't seem like they've done it yet, or at least haven't clarified. When you look backwards, so before this came into play, I believe at the very beginning of 2020, before that, there would just be an annual amount that you had to take out that started at a really small percentage that varied based on your age and then grew each year. So it sounds like that's what this person's got. Okay, let's read the rest of the question. I've been seeing conflicting information regarding the tax treatment if I were to pull out funds for a first time home purchase. If I were to take out funds from this inherited IRA in order to purchase a house, could I make the withdrawal tax free? No. No. I don't know where you're finding information that would even possibly lead you in that direction. Um, there is a first time homeowner withdrawal from regular IRA. It's yours, not an inherited one, where you can avoid the normal penalty, but you got to pay taxes no matter what. Um, yeah. And then you say, if not, what would be the best way to get funds out of the IRA in order to buy a house the next 2 years without paying a fortune in taxes? Okay, well, whatever you take out is going to be taxed as ordinary income, as if you earned it. One thing you could do is spread it out. So you could take some out this year, 2023, you could take some out next year, 2024. And if you were thinking, 2 years means sometime in 2025. And now whatever amount you needed to get out for a down payment or a purchase, you've spread it out over 3 years. Let's say it was $150,000. Now you've only put an extra 50,000 of taxable income on each tax return instead of if you wait until 2025 and you take it all out right then, it's going to be 150K of extra taxes. Now, that won't be a huge amount. Well, we can run the numbers real quick. Here, let's jump over to our Excel file. So we'll just make a couple things up, but we'll stick with our 150,000. Oh, we got a percentage in there already. It's not what we want. 150,000. And then let's pretend that your state your state tax is gonna be flat. That may or may not be the case, but federally, 150,000 could, for the sake of argument, be the difference between being in the 32% bracket or being in the 34% bracket. Of course, you may be in different brackets. You could be in 10, 12, 22, whatever. But let's say it's an 8% swing. And perhaps it's an 8% swing on all of the $150,000. I don't know. But we could be talking about paying 48,000 of tax versus paying 36,000 of tax. So you could save yourself potentially $12,000 if spreading it out keeps you in the 24% bracket versus taking it all in 1 year puts you in the 32% bracket. Of course, the difference might be less or more depending on your circumstances, but that's one thing you'd think about doing. Good luck with your decisions. Be sure to tune in tomorrow for the next episode.